So let's start the webinar. Somesh, welcome. Everyone, good morning. I'm Dr. Sumit Pava, and joining me is Mr. Somesh Kumar. Let me introduce the speaker, Somesh. Somesh is a seasoned legal and compliance professional with over 12 years of extensive experience in managing legal, regulatory, compliance, governance, and risk matters within the financial services sector. Somesh is an LLB, fellow company secretary, master in business laws from NLU, AML KYC certified by Indian Institute of Banking and Finance, and has attained the Chief Insurance Executive designation from Insurance Institute of India. Uh, he has held key positions with several MNCs like GE Capital, Clicks Capital, Cars24, Pine Labs, Home Credit, etc., and specializes in navigating complexities faced by NBFCs, housing finance companies, prepaid instrument issuers, insurance corporate agencies, etc. Currently, Sumesh is serving as a Director of Compliance and Operations Quality at Propelled Group, focusing on the education loan business. So I know Sumesh for good 15 odd years or more, and I see him as an expert in NBFC regulations, and therefore we invited him to today hold a masterclass on NBFC. Why this topic becomes important is because RBI, as you would have known, has issued a recent circular on 31st January, directing all NBFCs to implement compliance software, transition from manual processes to comprehensive, integrated, enterprise-wide, workflow-based software solutions. And we've also seen in the past RBI getting extremely cautious and extremely vigilant about the compliances and extremely strict, I would say, with some companies having been penalized, with cancellation of licenses overnight and with their market cap eroding overnight and their businesses eroding overnight. RBI anyways has been a very, very vigilant regulator, but of late, like all other regulators, RBI's scrutiny, vigilance, regulation, inspections, governance standards have only increased and they're increasing. So in that context, we thought it will be very prudent and a very good time to invite Somesh as a seasoned NBFC compliance specialist, having spent 10, 15 years into this domain, to enlighten us with the entire gamut of NBFCs. And I've asked Somesh to be very, I would say, non-jargonish, because I'm sure many professionals would love to learn about NBFCs. They may not be knowing as much, and some may surely be representing NBFCs today. So let's do a very small introduction about me. I am the moderator, Dr. Sumit Pava. I am a corporate lawyer, company secretary with 25 years of experience in legal and compliance domains. Currently, I'm the co-founder and CEO of Complinity, which is India's leading compliance software, helping companies comply with the laws of India. Complinity covers 2,500 laws and 37,000 compliances, updated on a daily basis. And we are adding value to 1,000 plus companies in India, more than 13,000 users spread across 100 plus industries, from organizations like Panasonic, Max Hospital, Oberoi, Toyota, Yes Bank, British Council. And on the BFSI side also, we've got good double-digit customers being Yes Bank, Suco Bank, TVS Credit, IIFL, DMI Finance, DMI Housing Finance, and many more. So we are your compliance partners, and this is the sort of compliance wire series. So on this note, Somesh, over to you. I won't take too much of time, but one very quick opening poll I would love to launch to understand the audience. So audience, very quickly, within the next 30 seconds, if you could fill up. Do you have experience in dealing with NBFC compliances? Yes or no? And what describes you best? This will give an idea to the speaker of what is the complexion of the audience. Okay, last 5 seconds. Very quickly, please. Last 3 seconds. Somesh, can you see the results right away, or do I have to share it for you to see it?
Currently not visible for me.
Okay. I'll quickly end the poll, share the results, and then we move on. Be ready with the presentation. What you can do is, Sumesh, in the meantime, you can start sharing your slide, and I'll end the poll in a moment. Okay, so I end the poll and share the results. So some 57% have experience in dealing with NBFC compliances, Sumesh. So that's like a 57-43 split. And 34% are practicing. Then there are in-house company secretaries, general counsels, compliance professionals, mix of all others. That's what the audience complexion is. Okay, over to you, Sumesh. And looking forward to a great session. And by the way, audience, the uh, you can put in your question in the Q&A box all through the session. We'll take the timelines will be that from 11:40 till 1 o'clock, Sumesh will be going through the presentation like a masterclass. And from 1 to 1:30, we'll take the Q&A. We'll try to finish sharp at 1:30. So over to you, Sumesh.
Hello, hi everyone. Today's key agenda items is like just five, six I have selected for you. Emerging trends that in the NBFC sector, and then the requirements regarding registration and prudential norms. This is always a query comes from in-house counsels also and practicing professionals also. And now to understand the regulatory directives which is in queue and which is already released by the RBI for NBFCs and the overall perspective we will come to know of RBI. Then we will cover the recent RBI penalties, why these penalties are coming, on what basis, what is RBI perspective, and then what step you can take. You should approach Department of Financial Services, Ministry of Finance, or you should approach High Court, because Sumit already mentioned that overnight RBI comes and say that you need to stop your business. So then what next for you? Then basis of these penalties, how you can take lesson and ensure fair practices in your business, NBFC business. And as you know, after pandemic, digital lending guidelines came out, and every NBFC, or in fact banks also doing their business through digital lending standards and or the guidelines. And in last, we will talk about governance oversight, which is crucial from GRC perspective, governance, risk and compliance side or control side. And we'll talk more on the compliance tool, because the compliance tool nowadays is a requirement for the in-house chief compliance officers. That tool is not only just for the sharing the checklist of the laws, but that tool is very useful for company secretaries or compliance officer or the general counsels, because one of the requirement also is now for the NBFCs to complete the compliance risk assessment. So that tool can perform compliance risk assessment also for you. Then it will be an additional benefit. So this is the overall agenda I picked for today's session. Now on the emerging trend side, so if you see on global level, so business is shared by the banks and NBFCs in equal portion, 50-50. And if you say that if 1 lakh crore business is done by NBFC, so you can say that 1 lakh crore business is done by the banks also. But in India, the contribution is only of 15% in the financial system. And banks represent around 58%, and other financial institutions, insurers, mutual fund, pension funds, they accounted for 26% around. But the 15% number is also big for India, because the Indian economy is also big as compared to other countries. And if you see the graphs, so even in 22, there is a 12% growth rate visible. Means business is growing by 12% every year in NBFC. And I don't have the data for 23, but I'm sure it is more than 13 or 14% only, because what I heard from others also. Now, just before starting, that the compliances of the NBFC. So I just prepared this slide, which gives you the brief background or the brief history of the NBFCs, how NBFCs came in picture, and how regulations came in picture, and the way how it is going on. So if you see that 1964, the new chapter inserted by the government in RBI Act, which talks about Section 45IA and other sections also connected to the NBFC, that a non-financial institution business can be uh, done by in a company, but under certain conditions which are laid down under Chapter 3B. In 1974, after 10 years, new sections were inserted regarding inspection rights given to the RBI, then enhanced penalties provisions came in picture. Then after 20 years, 1994, first time prudential norms came. So now prudential norm means what? Prudential norms means whatever loans given by the NBFCs will classified as the asset of the company in the balance sheet. So how you will consider those asset as a standard assets means that 100% money will come from the borrower, or 50% money come from the borrower, or there is you have a doubt. So that's why these kind of norms introduced in 1994 basis of Shah Working Committee. Then in 1998, first time big regulations came in picture, that we still call is that NBFC regulations 1998, and these are on the basis of non-deposit taking NBFC or deposit taking NBFCs public fund, they can accept public deposits or not. So first time the first categorization came in 1998. Then in 2006, first time they have further categorized NBFC, which are non-deposit taking, into two categories: systemically important or non-systemically important. And the criteria first time they have fixed is 100 crores. But in 2014, I still aware that November 10th was the date, or 9th November 2014, revised regulatory framework, introduced with lot of regulations. And one of the regulation was that, they have enhanced the net on fund criteria from 25 lakh to 2 crores. Then systemic criteria also increased from 100 to 500 crores. And the first time they introduced governance disclosures, others requirements. So in governance, they have defined a requirement of risk management committee, audit committee, nomination committee, fit and proper status for the systemically important, basically that point of time. And then prudential norms, they have first time standardized that, different categories they have defined for the prudential norms, like on the standard assets, 0.25% provisions required to be created for non-systemically important. So that kind of rules regulation came, and including KYC norms, further they have defined in 2014. Now in 2021-22, what happened during pandemic is that government thought that they have to further modify the NBFC's classifications, because that is urgent requirement, because now they are playing a good role in the Indian financial system. So that's why scale-based regulation introduced for 9306 NBFCs. So that is a number as on June 2024. And if you see the number before pandemic, that was more in 2019 or 2020, the NBFC's number was around 14,000. So if you see drastically reduction in the NBFC's numbers, I think RBI has around cancelled, or somehow they have reduced around 4 to 5,000 NBFCs. And out of that, base layer NBFCs are 8,857. So if you say that this is a big number, base layer NBFCs means those NBFCs whose asset size is less than 1,000 crore. And the middle layer NBFCs means those NBFCs whose asset size is more than 1,000 crore. 440. And out of these 440, certain NBFCs are selected for the upper layer. RBI time to time decide that which NBFCs should be classified under the upper layer basis of their several parameters, which they assess at the time of inspection also. Like if NBFC is giving loans only in the priority sector means they are only providing loans to the agriculture, for the agriculture purposes, or maybe in the real estate, and asset size grown tremendously from 1,000 crore to 10,000 crore, 20,000 crore. And basis of that parameter, RBI will say that this NBFC requires classification into upper layer category. And the beauty of the upper layer is also that within 3 years, listing can be done by these NBFCs. So they are eligible for the listing also after 3 years. RBI allow them. Basically, SEBI always ask NOC from the RBI whenever any NBFC goes for the listing. So they will not object on the listing also. Top layer NBFCs as on date, no one. Top layer, in short, I can say that for your better understanding and for in simplified terms is that you can say that which are highly unique, qualified, important, and can be considered equivalent to the bank. But as on date, they have not categorized any of the NBFC into top layer. Next is the NOF, 2 crore to 10 crores. And see, the beauty of the regulations of scale-based regulation is that they have said that existing NBFCs needs to increase the net on fund after a certain point of time. Like by 2025, they need to reach uh, uh, net on fund of 5 crore, and then simultaneously by 2027, 10 crores. But for the new companies, they have not mentioned anything. But when you will go for the application, go for the registration, RBI will say that have you complied with 10 crore NOF. Now 23, 24. Now what is the scenario? RBI aims to apply uniform regulations for NBFCs and banks. Like if you see frequency of credit informations, now bi-monthly within 15 days, NBFC also required to file with CIBIL or any other bureau all the credit data of borrowers. Willful default screening and reviewing committee. So willful default is also applicable on every NBFC whose asset size is more than 1,000 crore. So those NBFCs, basically middle layer NBFCs, need to constitute now a screening committee, review committee. Earlier, these guidelines were applicable on housing finance companies, HFCs, but now it is applicable on every NBFC, which falls under the middle layer. And these are also equally applicable for the banks. Now, for the digital lending guidelines in April 2024, they came out with key fact statement, revised formats, and more detailed, where you need to disclose APR also, charges also, detail of lending partners, digital lending app, lending service providers. And this key fact statement needs to be adopted for all loans which will be given by the bank and NBFC. Then Sumit already mentioned about compliance monitoring and tool you require. January circular came, and this is equally applicable for banks and every NBFC, irrespective of layer, in which layer NBFC falls. Information technology governance, risk control, and assurance practices. So here I just want to highlight is that this is equally applicable again for the bank and for the NBFCs. But the beauty of these laws is that, or the regulation is that, this is applicable for the middle layer NBFCs, upper layer NBFCs. And in the same circular, they said that earlier circular related to IT framework that came in, I think, 2016 or 17. Now we are now we are revoking that. But now there is even I am also in doubt which IT circular will be applicable for the base layer NBFCs or the NBFCs whose asset size is less than 500 crores. So there is a lot of ambiguity, because if you are able to find out, just tell me also, because I feel that after reading these new guidelines, which is equally applicable for the bank and NBFCs, I'm not able to find out the name of base layer NBFCs in those news guidelines. Framework for the settlements and write-offs. This is also came in 2023. I think in November 2023 or before that, that came. And this is also equally applicable for banks and NBFC. If customer is not paying the loan, then how you can do in a settlement with the borrower, or how you can technically write off that particular account from the your books. So settlement can be done within a maximum period of 3 months. If you say that customer will pay in next 6 months, this is what I have agreed, then that it will be considered as a restructuring of the account, not the settlement. So settlement needs to be done within the 3 months, whatever you agree through settlement letters. Next and important is that internal ombudsman. Here is also ambiguity that base layer NBFCs are falling under internal ombudsman criteria or not. But CIMS portal, complaint management portal of RBI, willfully and base layer NBFC can also register, and they can take the logins, they can appoint the nodal officers. If any customer will file the complaint on CMS portal, so that will be for automatically forwarded to the NBFC. So this is my recent experiences also, that you can willfully go and apply for the CMS portal. But internal ombudsman is something which is a few guidelines defined for middle layer and upper layer. So currently not applicable for the base layer, but willfully, if you want to appoint, it's a good practice that if you want to appoint internal ombudsman also, because your company is in digital uh, lending business as on date. So willfully you can appoint internal ombudsman also. So this is an overview. In 2023-24, you will see that if majority of regulations, 75% of the regulations are similar for the NBFCs and bank, which are equally applicable on both of these financial institutions.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000+ laws and 24,000+ compliances, all in an integrated platform that is easy to use with automated alerts and risk management capabilities, is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management. Request a demo at complinity.com.
Next is, here today we will only cover the registration and prudential norms for the NBFCs which are governed by the RBI. Those Nidhi companies, Section 8 companies are governed through Ministry of Corporate Affairs, Companies Act. Even chit fund companies are controlled by state registrars. IRDA controls insurance companies. Insurance companies also keep investing into NBFCs or any other company, so they also are considered as financial institutions. Merchant banker, broker, sub-broker, venture capitalist funds, stock exchange, they are controlled by the SEBI. But here today we are talking about those and non-banking financial institutions which are controlled by the RBI, and that is known as an NBFC, non-banking financial company. So NBFC means a company first to be registered under the Companies Act, then that registered under the Companies Act, basis of the incorporation certificate, they can approach for the RBI. RBI already mentioned everything on the website that these are the requirement if you want to approach for taking the license. So once you will incorporate, you will infuse another fund of 12 crores so that you can maintain net on fund of 10 crores. And 2 crores can be utilized for your preliminary expenses, MC expenses, office expenses, staff hiring expenses, IT infrastructure. You can do initial contracts to show and demonstrate to RBI that yes, you are passionate about launching the NBFC business, and that's why you are incurring expenses also, and you have maintained 10 crore rupees net on fund also. But what under NBFC? ICC, investment credit company. Investment credit company means a company which can do investment also or can provide credit, means loan also. So most of the NBFCs falls under this ICC only. Out of 8,000, 8,500, you will see that more than 6,000 you will see in this queue. The logic is only that investment allowed, credit allowed, and this category formed after merging three different NBFCs like loan company, investment company, asset finance companies. Now these companies are known as ICC. Microfinance companies means those companies which are giving loans at very micro level, very short amount in the villages, deeper areas of 2 lakh, 1 lakh. So exact category, amount you can check in the guidelines, but the household income is should not be more than 3 lakh rupees. Then that account will, then that borrower will be considered as an MFI borrower. If overall family income goes more than 3 crores rupees, then that loan will not be considered as a loan given under MFI, microfinance. ARC, asset reconstructions companies. ARC is also considered as NBFCs. Whenever any like ICC is struggling in getting the funds from the borrowers, so those loans can be transferred to the asset reconstruction company, saying that I'm not able to uh, generate my interest amount and not able to collect my principal against these loans, but I'm transferring to you. You can pay me the consideration, and then you keep collecting the funds. So that is how ARC works. Infrastructure finance companies means it's obviously infrastructure related. Big infrastructures require big investments, big loans. So these are normally very big and huge companies, basically controlled and managed by the government only. Next is infrastructure debt. Similarly, for infrastructure, if any debt is required, so here in both the categories, you will see only 10, 15 NBFC only, but all those are related to government sector and government owned NBFCs, because infrastructure is basically financed by the government only. So that's why they have incorporated for specific purposes these infrastructure debt and infrastructure finance companies. P2P is basically in a platform where a borrower and lender can come, they can meet, they can agree on the loan terms, and P2P allow these deals through its platform. Factoring means basically, if you see in factoring, there is in a trade portals also come. So a lot of factoring NBFCs allows MSMEs to discount their bill. If MSME is struggling in getting clearance of the bill, they approach the factoring NBFC saying that this is my bill, my payment will come in 60 days, but give me amount today, and you can collect from my you can collect from my debtor that amount after 60 days, that I am assigning you the right. But to make it more mature business, digital business, RBI launched trades portal also, through which factoring NBFC and MSME buyers and sellers can interact. So that is also considered a trades portal will considered as a payment system provider, but factoring NBFC can be the participant of the trade portal. So this is how factoring works nowadays in India. Core investment companies, if you see any of the group, Religare or any group, you see that on the top there will be a core investment company, means within the group they are investing in the form of loans and advances. You can say Tata Group, any group you can check, there will be a CIC. 90% of the assets are in the form of the borrowings, loans, investment into group companies. If your CIC asset size is less than 100 crore, then no registration required from the RBI. Once you will cross the 100 crore asset size, then you have to apply for the NBFC license for core investment company. Housing finance, very simple, which provides loans against properties, loan against home, or loan against flat. Means this is basically controlled by National Housing Bank, and National Housing Bank allows such kind of registration, but after merger or you can say that recently in last 1 or 2 years, uh, I believe except inspections, every registration related, every approval, every regulation now released by the RBI. So that's why I removed the name of National Housing Bank from here and now parked under the RBI. Account aggregator. Account aggregator is basically kind of an like P2P or trades portal that account aggregator basically allows the NBFC. It itself an NBFC, but it allows the most of the NBFCs and banks that they can fetch any bank statement of the customer. If customer will provide the consent, then account aggregator can fetch any of the statement on behalf of the customer, and that can be forwarded to the lenders like NBFCs or the banks, and these statements are used for the credit appraisal. In terms of section 45 IA, I already told you that without obtaining NBFC license, you cannot do business. You have to obtain the license and you have to maintain the NOF. This is in a registration process. Now, Parva portal has been launched where you can apply for the or where you can file your application. Even you can file your application for change in control and management. Even you can file your application for other registrations also. So this is an I think 30 to 40 services are mentioned by RBI through which through this portal which RBI will entertain all the applications. But if you see the criteria, they have defined 3 applications format which is visible on the website.
Looks like some connectivity issues at the end of the speaker. I think let's wait for some time. Yeah, the speaker is just joining in. There's some connectivity issues only. In the meantime, if anyone has any questions, I can see a couple of questions landing in. So any questions till now on the types of NBFCs or anything of that sort, you can please put it in the Q&A box. And also to talk about, my team has shared the links of the social media. So, the recordings, etc. of this webinar and some videos, derivative videos will be put on the YouTube. You can also subscribe to our LinkedIn, Insta, Facebook, Twitter. We are also available on Spotify as a podcast. So whichever channel you like, please subscribe to it. You will be able to receive notifications whenever we post resources and content. Also, this is my LinkedIn I've just shared. So you can connect with me here as well. And I post a lot on leadership and emotional intelligence nowadays. I'm a PhD in emotional intelligence. Although otherwise I'm a CS lawyer, but I've been writing a lot about emotional intelligence and leadership. So you can follow me here for if you're interested in the topics on emotional intelligence and leadership. Okay, I think a couple of minutes and the speaker should be back. Thank you for your patience.
Hello.
Yes, Somesh, we can
I'm
hear
so
you.
I'm so sorry. I don't know how it was.
No problem, no problem. We're all waiting actually. Not even a single participant dropped. So we're all waiting for you, Somesh. It's a very insightful session. Look forward to continuing. And the only thing is, Somesh, since we are broken, I'm sharing that be aware of the time. Maybe if you are slow, maybe you can slightly be fast now. Yeah.
Sure, sure. So, so type one, type two. Type one is basically the investment companies which don't require any interface or customer service desk. But type two NBFCs are those which require grievance redressal mechanism, and they need to mention about fair practice code, grievance redressal officer details. So these needs to be submitted for the type two. And then specific category you can select if a company you want to incorporate or register as a housing finance, microfinance, P2P. So like that you can mention. Then you need to submit company's information. Company's information is like that whatever you have submitted for the MCA, you have to submit the details here also, that you have not received any FDI. If you have received any FDI, then you have to disclose that also. You have to attach FCGPR forms also, and FIRCs also. You need to attach your COI, MOA, everything. So this is company information. Then auditor certificate is required. So before, and that whole application needs to be certified on every page. So that certificate is not required, that is not sufficient. But with certificate, every page needs to be certified by the auditors. So be ensure this, and auditor will certify the net worth of the shareholders. They will mention about UBOs also. If there is any unincorporated body involved, that he will also mention on the certificate. Then the capital fund, NOF, a financial statement in form of capital fund statements to be prepared in Annexure 2. Similarly, management director, CEO information to be provided in Annexure 3. And if you most of the time it is visible that people are just mentioning the profile of the directors. They are not attaching the certificates, like Sumit if worked in Genpact or G, so he need to attach experience certificate if you want to become the director or CEO in the NBFC. So those certificates will justify that you have a financial services experiences. So most of the time it is visible, they are not attaching, they just sending the profiles. And they are even not attaching qualification proofs also. If you are holding some three qualification, professional qualification, then you need to attach all of three. If you will submit the civil report, then you need to analyze civil report also of the director, that how many times he has defaulted. If he has defaulted, then ask for the clarification, because you will be the in-house counsel or the consultant. And then you have to reply back to the RBI saying that these are the some instances observed in the civil report of the defaults, but these defaults were for just of the credit card nature, just forgot we forgot the timelines. So something you have to prove that yes, these are just inadvertently missed. Then you need to provide business plan, net worth certificates of directors if they are the shareholder, also the banker reports also about your good standing with the bank. Experience I have already mentioned, qualification proof, civil. So similarly, if you are acting as a director or you have invested majorly in other entities, then those entities banker report and civil report also be shared. Then if you then if in case of like microfinance institution, MFI, you are applying for MFI, then you need to be the SRO, self regulatory organization. So MFIs or housing finance, like these kind of companies are part of self regulatory organizations, which helps these NBFCs in driving the compliance culture, how basically you need to do business. So SROs always mention their conditions and keep talking to these MFIs and housing finance companies. Policies, whatever policies around you have on IT infra, just attach all of them so that they feel that you are aware of registration, you are aware of the businesses, you are aware of the compliances. This is how you need to manage the registration. Now I ask that key questions about that: can an existing company become an NBFC without registration? A simple company can become an NBFC. If you see, if a manufacturing company given loan to other companies and that loan is in a huge amount and it is more than 50% of the total assets, then it will be, you can say that it has invested more in terms of the loans and advances in terms of, as compared to the manufacturing. So that manufacturing company is now more inclined towards the financial services business, and out of that loan, if he's that if that company is generating income also financially of interest, and that interest is also overall more than 50% of the revenue or the total income, then we can say that that company is satisfying the criteria of PBC, principal business criteria, that 50% of assets are in nature of financial assets, 50% of income is in form of uh, financial income. So it appears to be the NBFC. Can they simply then that company can operate as an NBFC without license? The answer is no. Because once your balance sheet is filed with the ROC, that will be forwarded to.
Looks like some issues. I'm really sorry on behalf of the speaker for this, but I think some things might be unavoidable. That's why. In the meantime, we've opened the chat box. I think it's a very important point at which the speaker left. If the existing company holds more than 50% of its assets and generates more than 50% of the income in financial activities, then will it be an NBFC or not? So it becomes an NBFC as per the principal business criteria. But please tell your comments in the chat box. What is your opinion? Like if the investments are done mostly in the group companies only, and if therefore it becomes a CIC, core investment company, then will registration be required or not? Because that's where I think the speaker left. So if you could mention your comments on the chat box, that whether registration will be required if a company has more than 50% of its assets and income in the group companies only. Somesh, are you back?
Yes, yes, sorry.
Yeah,
I don't know
Suresh,
what is.
I was wanting to ask a question here only, that if the 50% PBC criteria of more than assets, more than 50% of assets and income, one company holds in another company, but the other company is that group company only, and therefore it's in the nature of CIC, core investment company, then will the registration be required if the assets is less than
No,
100 crores?
CIC can do till 100 crores.
So if
CIC core investment.
group companies are investing, we make a company and we invest into other group companies, but the assets are less than 100 crores, but the principal business is only investment into your own group company. So then you don't require any registration, right?
Yes, yes,
Okay. Okay.
right.
Okay.
But
You can continue.
once you will cross 100 crore, you have to apply for the this thing.
Understand. Understand. And the link of the presentation will be there. Please subscribe to our channels above in the chat box, and the links will be you'll be notified of the links.
So now visible? Hello.
Yes, visible,
So,
visible, Somesh. Go ahead.
and I will tell you the one more beauty of this registration process. If foreigners are investing directly as an individual capacity, RBI will not allow them to form an NBFC. If they have some company outside India, even RBI will not allow them to register an NBFC in India. If those individuals have some kind of financial institutions and they have registered with some regulator, then that regulator provide CIR, confidential information report, to the RBI, and that yes, their conduct in our country is good. They are compliant. There is no MLTF seen in their business. Being a regulator, we recommend you can give license for financial services in India. We recommend that. Then it only the possible. But there also we have seen in many cases some of provide venture capitalist certificates. So that particular company SEBI is providing is no worth now. If their bank providing, like say Mass Monetary Authority of Singapore provide the certificate, then it makes sense. So equivalent to RBI, regulator should provide those recommendations in India for the foreigners or for the foreign group. Then only the NBFC can register in current scenario. Now the next slide, if you see, I have mentioned some of the definitions here about the loans, that principal or interest, if anything, remain overdue. Overdue means day past dues, DPD. Then we have to categorize that loan into several categories. Like standard, if there is a no default, no overdue of principal or interest, I will say this loan is standard in my balance sheet, standard asset. If I will say yes, initial stress visible, non-cooperation visible, default visible of 1 day, 2 day, 30 day, and maximum 90 days, then we will call those borrowers accounts as a special mention account. And default is already defined under the insolvency and bankruptcy code. Then after 90 days, that account will become the NPA. If interest is remaining for more than 90 days, then you can call out that particular borrower as an NPA. I forget to change the slide. The substandard is now basically the NPA, which remains for the next 12 months, or the terms has been renegotiated. So that will become a substandard asset. And then the doubtful asset is substandard assets, which remain again for the 12 months. So if you see in this slide, from DPD 1 to 30, we will call that account as a SMA 0, special mention account 0. Then 30 to 60 SMA 1, 60 to 90 SMA 2, 90 to another 12 months means 455 days, that account will become a substandard. And after 455, that will become a doubtful asset. So this is the way how you will define your loan or your assets into the loan and advances into the balance sheet, means standard assets or non-performing assets. If it's a standard, SMA1 or SMA2 or SMA0, or non-performing substandard or a doubtful. And loss asset can be become at any point of time, like quick mortality. Like today I have taken a loan, or maybe next person taken a loan from a bank for housing purposes, and next day he died. So that borrower become a loss borrower or loss account for the bank or NBFC. For I specifically highlighting for the standard assets, if NBFC's asset size is more than 500 crores, though it fall under the base layer, but they have to file on the monthly basis main return of all the accounts or all the borrowers who has taken a loan of 5 crore or more in Form DNBS 8. Here, if you see those loans, those accounts or those borrowers who have taken a loan of 5 crore or more and stress visible, and that's why you are categorizing from DPT 1, day past dues 1 to DPT 90. Wherever you are classifying SMA 1 or SMA 2, those accounts needs to be filed in monthly basis. This is on a main return, and on weekly basis, you have to file in DNBS 09. So like this week, one borrower defaulted who took on a loan of 10 crores. So immediately on weekly basis, you will file it. You will not wait for the monthly returns. So after these categorizations, as per this circular, which is visible in front of you, prudential framework for resolution of stressed assets. So a resolution can be provided for the stressed assets. Stressed assets, again, I am writing, not the NP asset, non-performing asset. So if you are in stress, 10 days, 30 days, up to 90 days, then borrower can get some kind of facility or relaxations, then that account will can be restructured as per the restructuring policy of the NBFC, and that account categorized as a substandard asset. And for remaining 1 year, it will be the substandard only, because you need to perform satisfactorily. If you perform satisfactorily for 1 year, then from substandard you will come as a standard assets. And those who have conducted although frauds, they are the willful defaulters, then they are not eligible for the restructuring. And once you have classifying your assets, then you have to create provision also. Like, that this is a standard asset. So you assume that you will, if you are given a loan of 1 lakh rupees, you assume 1 lakh rupees will come. But there might be an instance that a check will be dishonored. So might be for that you have to again call and coordinate. So might be for that you have to incur some expense, right? So that's why they are saying that even if for the substance for the standard assets, you need to create provision of 0.25%. So see, this is a very small amount for the standard asset. If a loan is of 1 lakh rupees, 0.25%, you say that this can you need to create a provision of expense. And if you are not in the base layer, then on middle layer, then it will be in a 0.40%. But if your numbers are very huge, if your customers are in lakhs, then this 0.25% will become a huge number. And substandard, I told you that after 90 days, you will become on a substandard assets. Then if you 10%, means 10,000 rupees provisions to be created. So similarly for the doubtful assets also, that the substandards remains for next 12 months substandard, but after that will convert it into doubtful, like that, right? So then there are several, if a secured loan is given, then 20, 30, 50%. So it's on a slab based this given, so you can create provisions. But if for the unsecured 100%, and is 100% provision to be created, that amount will not come. It's all about provisioning. And ultimately, if you are sure that this is now a doubtful or the loss asset, obviously you have to write off the bad debts, right? So this is the way how balance sheet works. What is I have seen from last year is that whenever hello, I'm audible.
Yeah, Somesh, you're audible. Go ahead.
Okay. So from last year, if you see, I visited several times RBI, MCA. They always say that today ROC is busy in money laundering risk assessment, which is carried out nationwide, and there are so much government is asking. So the last year, so much work done by RBI and financial other government offices. And finally, if you are aware, that announcement came also that RBI is considered as one of the best bank also, right? So India's standard in terms of AML practices are now very matured, and the target is just to inspect the NBFCs is on the basis of AML side only. So that's why if you see that uh, they have in the later on slide, you will see that many penalties just came on the AML KYCs. Either the company are failed to assess the risk profiles, means they have given the loan, but they are not taking the profile, like that, from like I'm working in my company though, then they are not asking that where you are working or where you are staying. So profile needs to be created for the risk evaluation. So this was the one of the major drawback, from a lot of NBFCs. And these I'm just sharing also you that this is a crux of annual report. So source is with you. You can also study in detail if you inability to comply with the AML KYC guidelines, insufficient policies, procedures are found in the NBFCs. Then they have mentioned these in the reports. Then the weaknesses they have found in the customer identities, and lack of systems available for the monitoring of transactions, red flags. If a loan is taken by me, but Sumit is paying on my behalf, why Sumit is paying on my behalf. So that monitoring of transactions required at NBFC level. So customer behavior, from suspicious activity side, always looked upon, and a transaction monitoring committee also required, which should be comprised of principal officer, designated director as per PMLA. Then you can monitor those transactions with the FC. So regular review required, insufficient trainings. I have seen many legal counsels or practicing professionals are giving trainings on POSH, but no one is offering trainings on the AML sites. And there is a huge opportunity that you can be the good trainer, being a compliance officer or legal counsel, or practicing professional associated with the NBFCs. Because nowadays, like if I will say that in AML laws there are four pillars. Pillar one, customer identification, customer acceptance, and risk management and transaction monitoring. So on quarterly basis, for the four pillars, four trainings can be given. So likewise, there are n numbers of queries came from the inspection reports, and that's why if you see October 10th circular, I believe RBI now came out with internal risk assessment guidance note, that basically professionals how they need to conduct the risk assessment of the money laundering and terrorist financing. So they have pretty well explained, like we do secretarial audit, internal audit, statutory audit. So first time this came on the basis of Financial Action Task for recommendations in India, that they have now defined the whole process. And these processes were earlier defined under the Basel norms, international norms, but that were not in the RBI guidelines for the NBFCs or for the banks. But now they have specifically mentioned this guidance note is now visible on the very first page of RBI website. If you want to start those audits or with the help of that guidance note, you can do for that particular NBFCs. That is not a tough job. It's very simple. You can just create a checklist of PMLA rules and RBI guidelines, and against that you can check the controls in form of maker checker, which is always available in the compliance tool. And similarly, you can around those checklists, you can define the processes, and then you can say that there is a risk because this is a manual control, there is no risk, this is because this work is done in with the help of systems. So you just use those guidance notes. I think this is now earlier was a gray area that how to be conducted, but now it's clarified. And now the next year goal is already defined, that they will now focus more on the information security side. So IS audit framework they want to see, data governance framework, data cycle they want to see in the inspections. They want to analyze the data quality index also of the returns. So every returns now is filed on the CIMS portal, DNBS 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 13. So all the DNBS returns now available in new formats. Then those basis of those format, they can analyze the quality of your business and your numbers. And they are more now work from their office. They do not want to come and sit and say hi, hello for the next 7, 6, 7 days. But 1 or 2 days they will come, but they will not come for 6 or 7 days, because they will take now help from the MC also, because they have launched one program, Utkarsh. So under Utkarsh, they will get insights of your company from income tax, MCA. So that is a goal of Department of Supervision for the NBFCs for this year. And next year agenda are very clear, that if you are in digital lending and if you are having a digital lending app, and you are lending service provider and you are providing services to many NBFCs, then behave like as an insurance aggregator. Means if you want to buy one policy, so 7 option will come, that I will means this Max Life insurance will pay, you pay 5,000, they will provide you the motor insurance. So similarly, any digital lending app or lending service provider using any platform, then they should act as a web aggregator. So those draft rule always already circulated, but the nuances are like that. In loan, such offer cannot be given because we need to assess the income also. And for assessing the income, NBFC need to hit CIBIL also. So for just, if you want to see offer from 7 NBFCs regarding the loan interest rate, so you have to provide consent to different NBFCs through digital lending portal. So 7 times they are hitting your CIBIL report, so your score will go down. So these are just draft regulations, but a lot of maturity required, a lot of revisions required, a lot of interactions already happening through Digital Lending Association of India, DLAI, and NESCOM and others, lawyers, councils, compliance officers giving their opinions. But let's see when they will come with the final regulations. Now they are now what they are harmonizing the interest rate also. In subsequent slide, I will show you that fair practice is required. Fair for charging fair rate of interest, penal charge percent 50%. So they will soon come with a good regulations. That is already done.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000+ laws and 24,000+ compliances. All in an integrated platform that is easy to use with automated alerts and risk management capabilities. Is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management, request a demo at complinity.com.
Earlier we used to see compliance section 178, 179, 177 for for the committees. But now for the governance also, RBI is now defining their own standards, own charters for the committees, on terms of references soon. Prior approval required, that whenever any director is changing in the NBFCs, then if he is going, one is exiting, one is coming, and then the approval is required because there are only 2 directors. Now one director is resigning, one is coming, so change is more than 50%. So now they are revising it and thinking, because these approvals going in bulk, maybe they will increase it to 50% or somewhere they will freeze it. Draft regulation for the connecting lending. So this regulation was much awaited, because that is in a story of Religer also. I'm just quoting for the, you can check the, for studies and academic purposes only, and and on the basis of the report available on the website or the internet. In 2016-17, there are a lot of story. If you want to learn more on the NBFC side, I will say just search Religer Investment. There will be n number of case laws, n number of regulations you will see on the website. RBI inspectors inspected and highlighted that loans are given to the related parties. That is connected lending, means highly influential people are connected to the NBFCs and they are influencing that and expecting financial support from those NBFCs. So that's why new circulars are coming for connected lending also. Similarly, for the securitization, I told you that asset reconstruction company you can hire. If your loans are becoming bad debt in your book, then you can transfer to ARC. So similarly, securitization also works. A special purpose vehicle will be created, and that special purpose vehicle will take money from the investors and give it to the NBFC, and NBFC will transfer those loans, receivables, or amount whatever need to be collected in favor of SPV, and SPV finally pay out to the investors. So this is securitization of the stressed assets. So current guidelines 2021 is not sufficient. So that's why now they are now giving more weightage to these securitizations of stressed assets guidelines, and they will come with that also. Next is consumer protection assessment matrices. I have seen, and even you also got an opportunity to attend several ombudsman, nodal officers, conferences of the RBI. After that particular, if you see, every time they circulate the action items, right? That whether company are fairly doing business, complied with the practices or not. So they are taking feedback at each and every conference also, and through complaint management system also, that portal. And they are assessing that whether NBFCs are fairly dealing with the customers or not. So this is a very risky area now, that they are not earlier they are very relaxed, but now they are very very stringent on the fair practice code guidelines. So that's why they are thinking of developing those indexes also for publishing it. Impact assessment, enhanced risk assets, risk weights. So November 16 they said that if you are providing unsecured loan, so that unsecured loan is your asset, and against that asset a risk will be assigned, and on the basis of that risk the car will be calculated. So capital, and again is an terminology. The tier 1 or tier 2 capital are basically I think I should not touch upon this topic, but one day we can cover these returns and these prudential norms also related to calculation of tier 1, tier 2 subordinate debts, and how to assign the risk against each of the assets, how much risk to be assigned against the fixed deposits. So several kind of assets require risk weights. So on the basis of that circulars for the unsecured loans, so they are doing impact assessment, that after this increasing in the risk, how much impact in the profitability will come in the NBFCs. So that's why they will share some impact assessment in this year also. So this is a one slide, one go, only a single slide. If you see the comparison of base layer, middle layer, upper layer, and banks, I tried to compile every circular here only. Initial capital minimum requirement, bank 1,000 crore, NBFC we already discussed 10 crores. Capital risk weight asset ratio, I told you just this, that 15% is required now, and this calculated on the basis of tier 1 and tier 2 capital, and that is minimum capital which is required, means risk free you can say. Then the standard asset provisioning, we have already covered all the provisions, 0.25%, 0.40% for the standard, then the 10%, and then the 20, 30, 40, and 100 for the lows, right? Then the internal capital adequacy assessment. This is in a big change years for the middle layers, because these are based on the Basel norms. And capital adequacy, I will just say that if you are handling the compliance and you got the notice from the SEBI saying that 5 lakh penalties, why should not be imposed, right? And you go and tell to management, I need 5 lakh rupees or I need 5 crore rupees. But then the promoter will say, or the board will say, that why you have not told us. Against each of the risk, compliance risk, legal risk, reputation risk, litigation risk, security risk. So in this, from every department confirmation taken, that is there anything which is not controllable or under control, or how much you feel the risk within your area, and on the basis of those calculations, and you say that I need, my department need 5 lakh rupees, then that on the basis of those assessments, overall department's assessment is known as internal capital adequacy assessment. So 2 years back it was introduced under scale based regulation only. This is not applicable for the base layer, but applicable for the middle layer. Credit and investment. This is not again the applicable for the base layer. That my loan portfolio is of 100 crore, and I have given loan of 50 crore to a single entity. So that is not allowed. I can't give my 50% of portfolio to a single person. I need to define at the maximum I can loan give the 5 crore rupees. These are the concentration norms, internal exposure limits, and the consumer credit limits. These are interconnected. November 16 circular, that if you are providing loans in sensitive sectors, right, to the real estate, then you have to create your internal risk assessment, and you say that if I am giving 100 rupees in form of the loans, then I will give 25% to the real estate broker, real estate owner, 25% for the purpose. So this is the way how you can define your internal limits. Similarly, consumer credit means loans. So there I mentioned that risk weight has been increased. I'm audible?
Yeah, Somesh, you're audible, but in
Sumit?
between you're slightly breaking up also. So if there is a way to get to a better Wi-Fi, then it'll be good. Otherwise, you can continue. We have no other option.
Okay. So similarly, governance disclosures also, listing we have already disclosed, core financial system also, and commercial expansion. In banks, there will be restrictions, but in NBFCs, you can open a number of branches. Priority sector lending, not applicable, but applicable for the bank. But if you see now the fraud, risk management, IT, GRC, I already explained. Now it's equally applicable on the banks and then NBFCs also. Now it's the interesting that few are the slides. This is the first time more than 2000 crore NBFC fine is imposed on cash bin, PC financial services, because that NBFCs were running a digital lending app and China, and they have transferred more than, I think, 1000 crore rupees. Just for the sake of that, we have to pay that just because we are taking the IT services. So this is the one major drawback. Then there is a default on the side of fair practices, outsourcing of the activities, collection activities. That's why ED slab is fine on NBFC. On the recommendations of RBI, RBI inspected, corrective action plan implemented, but they have not followed. Then the case transferred to the FIU, ED, and then finally October 11. After a lot of battle between government and PC Financial Services, this announcement came. Similarly, I told you the rally gear corrective action plan still imposed, but their tag can be removed as a willful defaulter or fraudsters. Recent news also in March month that IFL business has been stopped from just because of supervisory observations. And these are the biggest case laws and biggest breaches from the recent trend. GM Financial barred from loan against shares, less or securities, because they are not using the power of attorney, or they have master services agreement, or means there was a huge glitches on their credit underwriting processes that were not adequate, and they were handling demat accounts, they were handling everything of the customers, and it seems that they are only the borrowers and they are only the lenders. So that's why they have RBI raised questions on credit underwriting and business model. Similarly, IFL also, that gold loan business has been stopped because they were not able to do business on the basis of the valuation of the loan, valuation of gold. maybe they have issue on the purity side or maybe on the net weight side. So their valuation process was not strong, that RBI mentioned publicly. This is all insight for you to just to understand. I told you that last year was on the AML KYC side. All these NBFCs just got penalized for the AML KYC, or they have just doing collection in wrong way, or they are just outsource their whole important function. Now what next? If you see, this is just few of the extract. RBI will say that why should not you stop your business, or why we should not cancel your license. So these kind of letters will come 15 days, we are allowing you, or you can come in person, provide your response. So, and what in hurry NBFC legal team, compliance team, or the professionals who are involved, they basically say that we will present our business plan, new business plan 2.0, 3.0, and they never mention good strong reasons against each of the observations. Why I'm telling you is that if they are mentioning each of the observation, against those letter only you have to provide all the inputs, because once you will go in the high court or maybe on the Department of Financial Services, the legal articles. So from their side they have their own in-house counsel panel, and you appear from NBA side, you will say no, we have presented our plan. But the hello, I'm audible? So,
Yes, yes, Somesh, you're audible.
they will only dictate that we have received these responses. These are not satisfactory. As per clause number so and so, they have just furnished that thing. As per clause number so and so, they have provided that. So this is the way how it works. And these hearings in Department of Financial Services is like online only, or if you meet face to face also, they will not entertain more than 30 minutes or 60 minutes maximum. And from RBI side, there will be 5-6 person, means the particular general manager will attend, council will attend, juniors will attend. But from your sides, because might be you are not aware of the business, but you are aware of the technicalities of the business and legal language also. But there, I feel that DFS is the not the right form as per my experiences. So directly, you should reach to the high court for whatever appeal you want to file as per article whatever 226 or whatever you want to file, that you are barred from the business. So that is the right form, I will say, that directly go and jump high court rather than wasting time in the DFS. An overview of the fair practice code. Application form KYC is first to be collected, then acknowledgement of application to be given, KYC verification to be done through help of if I will collected in a PAN, that needs to be verified through the NSDL. If I collected the Aadhaar, then I will say this is certified from our side, like professional do certification of after after checking the original. And if they are collecting online, then offline Aadhaar KYC, OTP based verification to be done. Similarly, credit appraisal, income documents to be done. Then the most important terms and conditions, key fact statements to be shared with the customer. If they are okay with KFS, then the loan sanction letter can be issued and can be, and then the loan Always give prior intimation, 2-3 days intimation that you have to pay, you need to send reminder letters. So these are the fair practices. But RBI expectations written on the right side, what RBI is expecting. These are the recent trends, and these are some of the circulars I mentioned also. If you see in the last unfair lending practices, stop charging interest rate from the date of sanction. Whenever actual disbursement happening, from that day you should start charging the interest rate. So similarly, n number of fair practices recently mentioned. Digital lending standards, remote, automated, seamless. So these are the three important words. You can take a number of opinion on lead acquisition, first step, that whatever customers we are acquiring, then we are doing credit enhancement, assessment, then the loan approval, then the disbursal we are doing, then we are doing recovery, then the customer service. In my view, first four steps are important for digital lending because they need to be remote, automated, seamless. But what constitute digital lending in these four steps? Remote means there is no in-person interaction. Automated means minimal human intervention, means process itself running, and seamless technology in the entire process, application, approval, repayment without disruptions or complications. Now the core questions I mentioned is that what is the timeline, or what is the time required for the lead to disbursal process in the first four steps of digital lending. If I will say within 10 minutes I got the loan, can I call it as a digital lending? Or I will say that in those 10 minutes I was on call with the company for verification. Or you will say that 30 minutes is sufficient or one day is sufficient. So that is nowhere mentioned. But a lot of opinions are given by a lot of professionals or in-house counsels they are taking. But it's all depend upon how you judge your own loan product as a digital lending product or a normal lending product. Because digitally signed documents can be executed today, even if you are meeting customers face to face, or you are not meeting face to face, you can execute. A application can be submitted online to capture economic profiles. But if you are meeting, like I'm giving a perfect example, if you are buying a BMW and there is a company BMW Financial Services. Another example, TVS bike, and this is a TVS credit, but you are visiting their showroom to check the asset, then you are buying it. Means you are meeting face to face. That is a traditional method. Although everything is done through digital lending, but during that time you met face to face. So that is not considered as digital lending if you are meeting face to face. Although everything is happening digitally. So that is in a core, ambiguity still, that what is the perfect time to consider as a digital lending, what is the level of minimum human intervention, what is do you mean by in-person interactions means visit will be considered also, means you just need to solve as per your own loan products processes. This is now a better we talk about governance, oversight, and compliance tool, because this is the main reason for me to step into, because I'm also struggling and others also struggling, that can compliance tool be a role model for all the chief compliance officer or the legal counsels or for the legal and compliance team. Because in my sense, this is perfect time to, to highly utilize this compliance tool. But before that, RBI inspection requirement we discussed, that ready with vision, mission, your values, core standards, your leadership standards, your corporate structure, how many functions you have, how many departments you have, how many owners you have, how many shareholders you have. So that should be bifurcated between corporate structure and organization structure. So corporate structure means your shareholding structures. So they should know about ultimate owners. So keep handy with these documents for the RBI inspections, or not even for the RBI inspection. These documents can be asked through emails also, policies, disclosures on the websites. And if possible, all these you can publish on your websites also to the some extent, just for the sake of the clarity of the every stakeholder. Then your indoor management, your governance, shareholder meeting process, you can write board of directors, supervisory role, leadership role, you can define your board meeting processes, you can define KMP's role, CS, CFOs, CEO, full-time director, functional heads roles you can define, then the committees charters roles you can define. And these are the minimum requirement if your company falls under the middle layer. But if you are in base layer, risk management committee is sufficient. But if you are middle layer and upper layer, these are the minimum requirement. Apart from your committee is required as per Companies Act or for the SEBI's perspective. And then the fitness program also required that you have to collect every time, so many documentation from Companies Act side, then from RBI side, fit and proper declarations, their process note you need to design, deed of covenant you need to design. So likewise, these are minimum governance standard which you can define into one single document. It may be that document goes in some 100 pages or 200 pages, but this should be the complete governance process basis which RBI will give you the weightage whenever you will interact, because this is enough GRC's first part, governance. I'm not talking about or not expecting that you immediately provide operational risk manual to them or the fraud risk manual to them. But GRC is something which is very basic for the compliance and legal team to always be in the hands and can be shared any point of time. Now the thing is that whenever indoor management means management is changing more than 30% or your shareholders are changing more than 26%, then RBI approval is required. But in the case of the listed and public companies, is my own experience, I have seen that there are many shareholders, there are many relatives also, but within the promoter group, whosoever are connected, and if their shareholding is changing or they are acquiring further shares, then always approach RBI. This is my suggestion. And major shareholders, if your company is only in a public company, you are not listed one, but certain shareholders, Mr. X is holding 10%, B is holding 11%, then they are changing hands, means A is now will hold 21%, then you should approach even for that change also. You should not wait for 26% because they are much concerned about major shareholders change after 10%. But not for the public. Public can change the hands at any point of time in terms of the shareholding. Now this is the compliance tool requirements. I think this slide is for more to Sumit, but I'll explain first what is the expectations of RBI. RBI reviewed complete automation technologies adopted by the banks and NBFCs, and they feel that we are not up to the mark. Still, many banks and NBFCs have manual compliance tools only. Now I will tell you the logic behind it. Two logics. One, whenever RBI inspect, they want to see a one single document where they can see every compliance, basis which they can judge you. Number two, from the compliance tool, they will see your supervisory work, and from your digital lending app, from your loan dump, or from your whatever dump you will generate from your system. From there, they will see your business supervision. And the basis of those two documents, they can quickly complete your inspections, and they can quickly tell to the RBI also or their, main officer that this is what it is happening in the company. And trust me, your digital ending app means loan management system, loan origination system. They can any point of time now get the access. That's the way how they are behaving. And they will extract the reports like you, for X customer, you have charged 50%. For Y customer, you have charged 0%. Means you are distributing loans at free of cost. How you can do so? Oh, you are charging 50% at such level. This is not tolerable. So from that's why loan dump or loan Excel sheet is very crucial. That's the way how they are analyzing. Now they have also changed their inspection behavior. Earlier they want to see the physical papers, physical loan files. So that's why the compliance tool can save you from supervisory things, and your LS, LMS, your technology for digital lending also save you from from fair business practices. But another aspect of the compliance tool I want to highlight, which is I mentioned in the last, that the circular came in January. Now they have extended up to I think November, and during this period, most of the companies trying to implement, but still there is a lot of NBFCs has not implemented so far. But those who implemented, those compliance officers even think, or the legal counsel think that this compliance tool can be used as a compliance risk assessment also. Because the beauty, if I will talk about I will talk about Complinity only, because Complinity is in a workflow based. That is the technology requirement of the RBI that goes to the several stakeholders in the morning, in the evening, and you can create maker and checker, right? And the last and important thing is that timely updates are coming with, and with every compliance there is a note attached about new rules, regulations, and they are coming on your name, they are attached on your portal. You can say that for every compliance we have the process, for every compliance we have the maker checker, for every compliance my uh, compliance partner Complinity is doing inherent risk assessment. Means they will categorize that if I will do this rule, then 5 lakh penalties will come. So then I will say that Sumit Park as a critical, because 5 lakh is critical for me. I will say that 2 lakh is coming. Then Sumit Park is it is a major or moderate level. So you can define your inherent risk assessment also of your all the laws. And against those laws, after completing your inherent risk assessment, you can demonstrate that these are the controls. And these controls also have the evidences which you can anytime audit it. I think if these things are available for the compliance officer, even I feel that why an internal audit is required. Because it's my own opinion is that every compliance or obligations require two things: the controls, preventive controls, and the detective controls. For preventive controls, you are asking from the makers and checker to mention the thing whether you have complied or not, whether you have followed the rules or not, because you are providing every rules, every document in the tool only. So you are implementing preventive tools, right? And on random basis, just after 1 month or 3 months, with help of your compliance or legal team, if you are doing audit, means detecting further these obligations, so you can tell now where is the issue. You can say that the issue is in the process, the issue is in the maker and checker, the issue is in the system. So what else remaining? I feel that internal audit can be done, which is not for the regulatory compliances, like expense management, capex management, or like travel bill management, or travel expenses, or food expenses, something which is not returned but willfully you want to do just to fix the internal financial controls. For those, you can internal audit can be engaged, or you can hire for internal financial control some other vendor, or can you manage in-house. But governance, risk, and control can be controlled through compliance tool pretty well, and a well report can be generated by the compliance officers or the legal counsels. If you tell your own recommendations, or you will tell your own beautifications or modifications to your compliance partner, then they can modify it to the extent. And these are just not the sheets which I will call as the obligation checklist. This is your then the bible, and then the base for the audits also, and the base for the compliance risk assessments also. And then you can tell to uh, your management or the board that from this compliance tool I have picked the theme of say only compliance related to the collections, or compliance related to the fraud reports. And in this quarter I have done an audit. These are the compliance, these were the maker, these were the checker that was filed on that day. After evaluating the report, I found out that this was not filed in proper way, or maybe filed late, or still not filed, or still I feel that they have not defined the process note, but they are complied. These are my suggestions. This is compliance risk assessment. And compliance risk assessment is the main, like this circular in January 1 came. This is the for the compliance tool, but in 2022 for the compliance officers, where in whole compliance chief compliance officer appointment circular they talk about only on the this compliance risk assessment. So this is all from my side.
Perfect, perfect, Somesh. Thank you. I think you can unshare your slide, Somesh. First of all, on behalf of the audience, I mean, it's not a thank you note yet. The webinar is still going on, but it's a heartfelt thanks, Somesh, that it was very, I would say, technical, very enlightening, less rhetoric, and more masterclass, like a true masterclass where I learned a lot, believe you me. You started from the basics of what an NBFC is, what are the types of NBFCs, and then going to prudential norms and classifications and provisioning and the frameworks and tools, etc. Very nicely covered in this short time of say 1 hour 10, 15 minutes. I'm sure the audience would also have liked it. And there are many questions also which have come up. So I'll give you a voice rest for 60 seconds, Somesh. Have a glass of water if you will. We'll play a short commercial video, and then we'll come back to you for Q&A. Yes, over to my team for a small video on Complinity.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000 plus laws and 24,000 plus compliances. All in an integrated platform that is easy to use with automated alerts and risk management capabilities. Is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management. Request a demo at complinity.com.
All right, thank you. So, just again, 30 more seconds on this. Complinity compliance management tool offers the entire legal updates on a daily basis of all the RBI rules, regulations, master circulars, notifications, etc. It is catering to some good 25-30 NBFCs in India. And with this latest circular of RBI, mandating the use of compliance softwares for this industry. I think it's a very good move. This has come in the wake of a lot of non-compliances which were surfaced and unearthed in their investigations and scrutinies. So it is not just NBFCs. Of course, it applies to Complinity is working with 100 plus industry verticals like healthcare, pharma, manufacturing, and services sector, and many more. So if you would like to have a demo of Complinity, there's a link in the chat box. I just sort of pasted. Please fill up your name, mobile number, etc. And my teams will come back to you if you're interested. Now, this was on Complinity. I'll raise a quick closing poll also before we go to the Q&A. So you can also indicate if you would like to have a demo of Complinity in this poll also. And my team will come back to you. And also, would you like to be a speaker in any future Complinity webinars? We keep conducting these webinars almost on a monthly basis, and we invite subject matter experts on different areas, people who would have spent probably 10, 15 years, 20 years in those domains. Just like our current speaker today, Somesh, has rich 12, 13 years of experience into NBFCs primarily, and you would have seen his knowledge and skills. So if there's any area that you would like to speak on, please indicate. We will come back to you, check with you for your preferred area, so that we can come back and present you to our audience. So, and also if you would like to have a demo of Complinity compliance software for NBFCs or for any other industry vertical, please indicate yes here. You could also not wait anymore and straight away fill up that form. If you fill up that form, of the link which I've mentioned in the chat box, my teams will even call you earlier. But yes, you can write either yes here or fill up the chat, the form, or both. And now, Sumesh, are you ready for some Q&A?
Sure.
Yeah, so I'll ask you the questions, Sumesh, and you can then answer. So Ankit says that you had mentioned about middle layer, NBFCs. So some 440 NBFCs you had mentioned. Ankit's question is, does this 440 include the housing finance companies also?
Right. Covered.
Covered. Okay. All right.
HFCs are covered.
Sorry? Sumesh, you broke up. Can you come again?
HFC is covered.
HFCs are covered in the middle layer 440 number. All right. Now, Prateek asks, can company buy and sell shares of listed company and do trading in options or futures without having an NBFC registration?
Can you repeat?
Can a company buy and sell shares of listed companies and do trading in options or futures without having NBFC registrations?
Buying and selling of shares is an investment activity, including options and trading.
Right.
Will be covered as a investment activity, but the options are not the contract. And even in my past experiences, I tried to launch one loan product for one of my friend, and I said that options trading or funding against them or like that activity cannot be considered as a financial activities, because these contracts are not the contract or I mean these are based on future dates, which are not can be considered as right ones. But there is a second angle also in it. In SPAs, share purchase agreements, such kind of clauses are there. There is an eligibility and viability and enforceability as per the latest legal judgments, as per my knowledge. But in this kind of activity, I don't feel that this should be covered under NBFC
But
code.
would the 50% criteria of assets and income not apply to investment in shares? If a company is more than 50% assets and income is through investing in shares, would it not then come under that definition?
The investment, that first part will come, first pillar will come, but option and trading, that is something not the contracts, in
Understood.
my view.
Understood.
RBI will object.
Okay. Rajesh Kumar says, what is FIU and FinGate registration? Whether these registrations are mandatory for all NBFCs?
Financial Intelligence Unit is constituted in 2004, Chanakyapuri. There is only one office in India. And in every country, I believe there is a one office. These FIUs coordinate with each other to share, to disseminate, and to report any of the cash transactions, suspicious transaction. And each and every FIU can take information against any person or the entity from any other FIU also, including in FIU, a registration required for the NBFCs, and the practicing professionals also need to register.
Okay. Understand. Now, Satya says, please clarify whether KFS, that means key fact statements, to be maintained for NBFC base layer with asset size less than rupees 100 crore.
If they are in digital lending, then should be either 10 crore also. If they are started digital lending, you should implement it, sir. This is a minimum requirement.
Right. Now, another question again, kindly describe about policies to be followed by base layer NBFC with asset size less than 100 crore.
For them, one policy, very simple, fair practice code, plus you have to follow grievance redressal mechanism, plus income recognition, asset classification, and provisioning norm that we discussed a lot today. Number four, if you have a collection policy or code of conduct for the collections also. And number fifth, being if you are corporate governance policies with you. These five, six are minimum policies, but policies you can incorporate from IT side also, be at least business continuity plan or business, impact analysis. That should be the minimum.
Right. Krishna says 50-50 criteria is and criteria or criteria. That is, a company will be considered NBFC
And
only when both the conditions are satisfied or only one of the condition is satisfied?
both the conditions, sir.
Both the conditions. Yes. Now, is it justified that a company merely fulfilling the criteria of 50-50 be treated as an NBFC?
That's why I said that once you have fulfilled the criteria, notice will come from the RBI through ROC. ROC will forward to RBI. RBI will forward to the company that it seems you are NBFC. Please suggest what you want to do.
The question is actually more like on your opinion or judgment that is it a fair requirement or is it too much onerous?
No, it's a fair requirement. So it's an like, see, no, this is not a requirement of this NBFCs. It is a requirement in insurance broking corporate agencies also. If you are doing more than 50% of intermediation business, then you will be called as an insurance broker also. So it's a uniform for all the sectors.
Right, right. Okay. Since when has the NPA classification moved to 90 days? Earlier it was 180 days.
This is a still for the, if you see the, I will give you the practical scenario. NBFCs require fund from the banks or fund from the private equity players, so that basis of that fund that can be invested or given to the further person. So practically, if you will approach the bank or the PE players for your funding rounds, so they will say that you have to follow 90%, 90 days criteria only. And similarly, leverage ratio is 1:7 written in the law. Means 1 rupee you can count for yours and 7 you can as a debt. But practically 1:25 chalta as per bank practices. So I have told you what is currently applicable in the market and or
Right.
currently prevailing in the market.
Right, right. Okay, Pradeep says, what happens if a group holding company having investment in various group companies exceed 100 crore and that holding company has not obtained registration as systematically important core investment company?
Then you check whether 100 crore is invested in for on the basis of public fund. Just classify and tell the justify to RBI that there is no public fund. 100 crore is mine in my companies only. Can you further relax it? So they will consider it in my past experiences.
Okay. But otherwise, if it exceeds 100 crore, the company is supposed to seek registration normally.
Yes, if public funds like 100 crore you have invested and you have taken through some public issue and then you invested into your company, then obviously you will be the liable for
No, even if
answering.
it's not the public fund, even if it's the own company funds, but still if the investment exceeds 100 crore, then the registration is required, right?
No, there is an ambiguity, still ambiguity. That's why I'm saying that public fund is again the criteria.
Mhm.
Some means there is there will be in short, I will say that you just can say that there's no public funds, and I still expect for the exemptions. So as per my past experiences, they can give up to the 500 crores also, but a
Understood.
case to case basis.
Right. Now, Ankit says how to calculate change in management 30% within a financial year or at one go. Likewise, for control of 26%. I mean, how to calculate this change in percentage? Is it like in one go or is it opening, like how to, on which date do you consider, etc.?
Progressive change, like 17th October 2 directors, 18th October 4 directors, so 100% change. You take an approval October in December, again in January you want to onboard another 4 directors, so 4 plus 4 again 100% change, then apply for the approvals. So it's a continuous progressive change.
All right. In case of a MFI NBFC, whether agents appointed by a outsourcing party in the name of MBCs for collection of dues from borrowers required to have a DRS certificate? If yes, under which clause and act? It's a very technical question by Nivedita.
Can you repeat it?
It's a slightly longish question also.
No,
In
no.
case of a MFI NBFC, microfinance
Mhm.
institution, whether agents appointed by outsourcing party in the name
Mhm.
of MBCs for collection of dues from borrowers required to have a DRS certificate? If yes, under which clause and act?
That I will also, you
Yeah,
have
sure.
specifically asked,
Yeah, it's a
but
very technical question. Nivedita, come to eMinds Legal for a legal opinion. It is a very seems to be a very specific problem area. So you can connect with me and message me on LinkedIn, and I'll connect you to eMinds Legal, which is a corporate law firm, and maybe we can help you. The lawyers and the company secretaries can help you for the legal opinion if required. Sumesh is anyways in job, so he can't offer any legal opinion for payment. Okay. Uh, Whether co-lending guideline as per RBI also applies to co-lending arrangement between two NBFCs.
that apply, that apply. Even for between bank and NBFC also, in my past experiences, like in Home Credit, we have tied up with Aditya Birla, we have tied up with Karur Vaishya Bank. So NBFC to NBFC and NBFC to bank, and still it can be doable. So that is that guidelines always taken as a base only for the co-lending.
Understand. Perfect. That we are on the end of the, towards the end of the session now. The appointed time was 11:30 to 1:30. We are at 1:27, so we are bang on time. Thank you, audience, for attending the webinar, and thank you, speaker, Mr. Sumesh Kumar, for your sharing your knowledge. And the way you were speaking, it really showcases the rich experience and knowledge. It's not just a reading of the law that can give so much of knowledge. Behind these 1.5 hours is your 15 years of experience in NBFCs and compliances. So really, hats off to you, Sumesh, and really gratitude, kudos, and congratulations for conducting a wonderful session. This session will be available to all the people on our YouTube channel, and please, you can also subscribe to our legal updates and articles or our LinkedIn. Or you can, if you would like to have a demo of Complinity compliance software, how we can help the NBFCs or any other industry set up a world-class compliance framework in compliance with the RBI guidelines or the RBI circular. Not just compliance, as you saw, we have compliance, contract, litigation, internal financial controls, audit, assessments, etc. Many modules, 12, 13 modules. And you can pick and choose which modules you would like. But yes, softwares are the way to go because you get immediate real-time legal updates. We have got a 40-lawyer team behind Complinity giving you real-time legal updates. We've got a 40-people engineers team behind Complinity working on the coding and the features and the user interface. And of course, there's a good 10-people client relations team to ensure that your compliance software implementations are successful. And on a side note, as I said, I'm an author and a writer also. And I write on LinkedIn on leadership and emotional intelligence as a hobby. So if you'd like to connect with me, this is my link on LinkedIn. Please come and follow and like and subscribe my posts as well. Okay, and thank you. And people who have indicated their interest for Complinity, we'll reach out to you shortly. People who have indicated your interest to be a speaker, we will reach out to you shortly as well. Thank you for a patient hearing. Thank you, everyone. And thank you for my team for the logistics and IT support. And thank you, Sumesh, once again for a wonderful session.
Thank you, Zoe. Thank you.
Thank you. Bye.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000+ laws and 24,000+ compliances. All in an integrated platform that is easy to use with automated alerts and risk management capabilities. Is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management, request a demo at complinity.com.